Something serious is happening inside China's financial system, something that could quietly shake the global economy. Over the past year, China's banks have begun showing signs of deep structural stress. Bank failures, mass job cuts, and collapsing interest margins are no longer isolated headlines. They are part of a much larger story, the slow unraveling of one of the world's most powerful banking sectors. And what's unfolding could have ripple effects far beyond Beijing. In today's video, we're going to break down exactly what's going wrong inside China's banking system and why this crisis may be bigger than most people think. To fully understand what's going on, we need to take a step back. China's banking system is huge, with around $60 trillion, and completely different from Western models. While in the US or Europe, companies raise money through stock markets or bonds. In China, almost 90% of financing still goes through banks. These banks fund everything from skyscrapers to small businesses, from bullet trains to local factories. The big four banks, ICBC, Bank of China, Agricultural Bank of China, and China Construction Bank, dominate the sector. But beneath them is a vast network of regional and rural banks, many backed by local governments. These smaller lenders play a crucial role in supporting local economies. For years, this system worked beautifully. Banks flooded the economy with credit, fueling growth, especially in real estate and infrastructure. But that credit boom had a cost. Many banks became overexposed to risky loans, especially to real estate developers and local governments. And now, those bets are going bad. Property developers are defaulting. Local governments are drowning in debt.
这里边的钱是谁的嘛？是你们银行行长的还是谁的？是你？他是哪里人？不是人吗？行长不是人吗？这是我问，这是国家搞不了对呀、你跟是你找你们行长来。
Small businesses can't repay loans, and banks, especially smaller ones, are left holding the bag. The first major warning signs appeared when small rural banks started failing. Baoshan Bank collapsed in 2019. More recently, in 2022 and 2023, several rural banks in Henan province triggered national outrage when customers were unable to withdraw funds. The central government stepped in with emergency interventions. But these failures weren't just isolated cases. They signaled deeper problems within the banking system. These smaller banks are often poorly regulated, undercapitalized, and closely tied to local political interests. And when loans go bad, they don't have a financial cushion to absorb losses. At the same time, China's banks have started laying off workers at an alarming rate. According to official reports and leaks from within the industry, some banks have cut between 10% and 30% of their workforce over the past year. Even the big banks are streamlining operations, closing branches, and turning to automation. While this might seem like a cost-cutting measure, it's also a clear sign of shrinking profitability and slowing demand for loans. When banks start shedding jobs en masse, it usually means they are preparing for a tough road ahead. But perhaps the clearest sign of trouble is collapsing interest margins. A bank's interest margin is the difference between what it earns on loans and what it pays on deposits. In healthy times, margins are wide, profits are strong, and banks are eager to lend. But today, Chinese banks are seeing those margins fall to record lows. In 2024, major lenders like Bank of Communications and Agricultural Bank of China reported net interest margins below 1.3%, a level not seen in over a decade. The reason? The People's Bank of China has been cutting interest rates to stimulate the economy. But while loan rates fall, deposit rates can't be lowered as easily, especially without triggering a loss of public confidence. That means banks are making less money on each loan they issue. With smaller profits and rising risks, banks are becoming more cautious. Many have pulled back on lending to small businesses and property developers, the very sectors that once fueled their growth. And when credit dries up, so does economic momentum. In many smaller cities, construction projects have stalled. Local governments are delaying payments. Farmers and entrepreneurs are struggling to access capital. The slowdown is real and it's being felt on the ground. This situation matters for several reasons. First, it puts massive strain on local economies. Smaller banks serve rural China and lower-tier cities, places where big banks don't operate. When these banks fail or stop lending, entire communities are affected. Small businesses go under. Infrastructure projects are halted. Local employment suffers. Second, there's the issue of systemic risk. While China's government has the tools to prevent a full-blown banking collapse, the more banks that fail or come under stress, the harder it becomes to maintain stability. A wave of failures could trigger a crisis of confidence, deposit runs, frozen accounts, or worse. Third, and perhaps most importantly, China's banking troubles are no longer just a domestic issue. Chinese banks are major lenders to foreign governments and businesses, especially through the Belt and Road Initiative. If they pull back on international lending, it could squeeze emerging markets from Africa to Southeast Asia. Already, financial markets are on edge. Ratings agencies like Moody's and Fitch have downgraded several regional banks in China, citing elevated credit risk and exposure to non-performing loans. And global investors are growing wary of Chinese financial assets. So what's the government doing about it? The People's Bank of China has responded with targeted stimulus. In late 2024, it injected over 500 billion yuan into the banking system to shore up liquidity. Regulators have also encouraged mergers among smaller banks to prevent failures. In some cases, weak lenders are being absorbed by stronger, state-backed institutions. This consolidation is likely to continue in the years ahead. Experts from Goldman Sachs and Morgan Stanley believe China's banking sector is entering a period of deep transformation. That means more automation, fewer jobs, tighter lending standards, and a shift toward digital banking. But there's a limit to what stimulus can achieve. Unless the underlying problems, like bad real estate loans, massive local government debt, and weak consumer demand are addressed, banks will remain under pressure. And with China's economic growth slowing to its lowest level in decades, the path forward won't be easy. What should we expect next? There are a few key indicators to watch. First, keep an eye on quarterly bank earnings. Rising defaults, falling loan growth, or declining profit margins will signal more trouble ahead. Second, look for policy changes, especially around deposit insurance, lending rules, or interest rates. Any major shift could indicate worsening conditions. Third, watch for signs of public unrest or deposit runs, especially in rural areas. If confidence breaks, the situation could escalate quickly. So, is China heading for a banking collapse? Probably not. The government still has tight control over the financial system and plenty of tools to maintain short-term stability. But what we're witnessing is a major turning point, a shift from fast growth, credit-fueled expansion to a much slower, more fragile banking model. And for a country as large and interconnected as China, even a gradual slowdown could send shockwaves through the global economy.
Joining us from Beijing, Patrick Chauvenac, Associate Professor at the Tsinghua University. Patrick, your call for GDP figures.
Well, I think it's certainly going to be above 9%. The worry isn't really the slowing of the economy. Actually, the government's been trying to engineer a slowdown in the economy. The problem is, and the worry is, that if China isn't moving at these breakneck speeds, that it may reveal some cracks in the economy and in the system that's generating this growth. That real estate developers might start to go bust. They might start to drop real estate onto the market.
In closing, China's banking system isn't imploding, but it is cracking. Bank failures, job cuts, and shrinking margins are signs of a deeper, long-term transformation. For decades, China's banks powered rapid growth. Now, they face the difficult task of surviving in a world of slower growth, higher risk, and global uncertainty. If you found this breakdown helpful, be sure to like, comment, and subscribe. And let us know in the comments, what do you think is the biggest threat to China's financial future? Thanks for watching, and I'll see you in the next video.